So as a summary, after all the transactions, after you fill out the chart, it should look something like this. So notice that I filled in all 13 transactions here so you could see them all at once. And these are just the transactions. These are all the entries. So the question was asking us, what is the balance sheet at the end of the month? And then also how profitable was the company? So to get the balance sheet, what you would do is you would just net out all of these. So once you net all of these out, you'd get the total assets. Net all of these out, you would get the total liabilities. And then remember, the equity is capital plus retained earnings. And then this portion, all of this here, is part of retained earnings. I'm going to talk about that in a sec. But that's basically how you would come up with the ending balance sheet. And I'm going to show you at the end what it is. I'm going to have to erase all this just because there's not enough room. But just wanted to give a summary of how your chart should look like. Now, before actually giving the balance sheet, I'm going to talk about the profit. And then I'll talk about the retained earnings. So what I'm about to write here, it's not part of this chart. So you could write it after the chart, but basically when they're asking for profit, they're asking for net income. And what's net income equal to? Well, it's equal to revenue minus expenses. And what was the revenue for the period? Well, it was this 875 over here. That was the total revenue for the period. And then the expenses are basically all of these values here. And so we can add all of them up. And when you do add all of them up, you'd end up getting $410. So revenue minus expenses, you would end up getting $465. That's what the profit was in the first month. So when they're asking for profit or net income, you're just basically dealing with these two columns over here. That's the income statement. Now, related to that is the retained earnings, because remember that ending retained earnings on the balance sheet, it is affected by net income and dividends. If you remember from the fundamental accounting videos, what's going to happen, we had that $100 dividend. I'm about to use it, so just remember that. Basically what happens is we have beginning retained earnings on the balance sheet at the beginning of the period. However, in this case, because it's a new business, this was zero. Right? It is possible that you could get something like this with a balance sheet that's already at the beginning. So then you would take all of these amounts, all of these transactions, and you would add them onto the beginning balance sheet figures. So you would take that beginning assets and then net all of this out. Positive, minuses, net all of it out to get the ending assets. But because this is a new business, then there is no balance sheet at the beginning. All the assets, liabilities, capital, retained earnings was just zero at the beginning. But thought I would mention, you could also get a question where there is a beginning balance sheet and get all these transactions to input. So beginning retained earnings is zero. And then what do we add to the retained earnings? If you remember from the statement of retained earnings from the fundamental videos, we add net income and then we subtract the dividends. And then that is going to give us ending retained earnings, which is going to be on the balance sheet at the end of the period. So we're adding the net income of $465, which we got over here, revenue minus expenses. And then we paid ourselves a dividend of $100. So we're subtracting that. So when you net these out, you would end up getting $365 for the ending retained earnings. And so on the balance sheet at the end of the period, the equity portion, what's the equity split up into? It's split up into retained earnings and capital and owner's capital. And so the retained earnings would be this amount, the $365, and the owner's capital you still have that $500 that you invested initially into the company. And so the total equity would be $865. And so to get that ending equity amount and to split it up properly, that ending balance sheet amount, it takes a little bit more work from this chart because mostly from this retained earnings, because it's split up. That change in retained earnings is split up into revenue, expenses, and dividends. And then the revenue expenses, you want to get the net income from that. And then the net income minus the dividends gives us that change in retained earnings. And then you add that to the beginning retained earnings to get the ending. So you can't just like sum up stuff and get the equity. It kind of takes a little bit more work to put everything together. But what's nice, the capital row, or column rather, you could sum up, you can net out to get this value. And then the assets and liabilities, you can just net out as well. So you may have, again, beginning assets or beginning liabilities. In this case, there's 0. So we would just net out all of these values. And if you net out all of these, you would end up getting $1,265 for the total assets at the end of the period. And then the liabilities, if you net these out, you would end up getting $400. And we mentioned how that makes sense because you're paying off this with this transaction, and then you repaid your parents $100, so you still owe them $400. That's all your liabilities at the end of the month. And then notice that if you look at the assets, the liabilities, and then the equity, it balances, right? Assets equals liabilities plus equity. So that's a nice way to check at the end if everything is correct. It doesn't guarantee that it's correct because it could still be in balance and you could misplace these. So for example, like if you put this minus 625 as, let's say, an expense, then these would still balance and then your ending would balance as well. So it doesn't guarantee that everything was right here, but it's still a nice check to have at the end. All right, so yeah, the total assets are this, total liabilities are that. So if we did make a nice balance sheet, a nice format, like a vertical type of format, basically what we would end up with is assets. First off, proper title. So you'd have the company name, whatever the company name is. This would be a balance sheet. And this would be at the end of the month. So we didn't specify a certain month. Let's say it was like September 30th, or the whole month was September, then this would be like September 30th. It would just be a single day. Remember, balance sheet is a snapshot at a single date of what the financial position of the company. So the assets would be $1,265 in total, and then these could be split up into cash and etc. But let's just use the total amount. So $1,265. Then we have our liabilities on the right side, $400. And then our equity, and then equity we can go into more detail. We have our capital, which is still $500. And then we have our retained earnings, which is $365. And then notice if we add these up, left side, right side are balancing. Right, so that is the ending balance sheet at the end of the month, and then that is the profit for the month.